Yeah, guys, this is OptionProfessor.com, and we are going to go over the landscape in the commodity sector, and we're going to give you our opinions and our observations of what we see, and we're going to talk about a whole bunch of different angles as far as how to participate in this area. Just briefly, Option Professor does have a weekly update that we send out, like a market update, and at the end of the broadcast, we'll explain how you can get that free of charge and continue on to get our opinions and our observations on a weekly basis. We've been doing this for quite a long time, decades now, and we've had educational seminars live and on the webinar online. And so we've educated tens of thousands of people nationwide through hundreds and hundreds of seminars. So obviously we have a certain amount of knowledge in this area, and we're going to share our opinions and our observations with you. With regards to commodities in general, there are a lot of people who think we're in a secular bull market in this area, so that makes it exciting. And, some people are thinking that the recovery is going to give a tremendous amount of demand coming out in 2021. And many commodities are not in a situation where the supplies are adequate to hit the demand. Everything I think they said except wheat. Wheat, I guess, is fairly supplied. But the other commodities are a little bit tight. When the oil tanks down to negative 37 bucks and you hear the rig counts are going down and you hear fracking is going out, then obviously you start, and OPEC is cutting, you have a pretty good idea that the supplies, may start tightening up. And of course, you got no jet fuel going on right now and the traveling has been curtailed. So again, the concept, I guess, is in many of these commodities is that once we get the lockout done and people start returning to their normal activities, the supplies of some of these commodities are going to be too tight to the demand side, and that's what could cause some significant upside coming in. China's rebound has already started. And so obviously the demand out of China is quite good. USA and Europe is also supposed to be quite good. Another factor with this secular bull market that could be happening is a weaker dollar. And the longer the Fed keeps talking about negative interest rates and is not ashamed to talk about it because it's really not a positive, but they don't mind talking about it. And that, again, could be negative for the dollar looking forward. It obviously already has been because the dollar index has gone from 104 down to 90. So, but they keep talking up this negative yield, and that is, again, a positive for the commodities. And the central bank's dovish attitude throughout the entire world is also positive for the commodities. And so, the commodity indexes, some of them are hitting a 6-year high. So, the rally's already started, up 10% this year on some of these indexes. So, the idea is that there's more to follow in 2021. So, we're going to go through the wide range of available markets and talk about a wide range of ways to participate and go from there. Stock market's wild on Friday, wild today. I mean, I don't know if it's the fact that they put Godzilla into the S&P index because, Tesla's valuation is so tremendously large right now that it obviously must have had some disruptive influence. And then, of course, the Fed coming out saying the stocks on the banks could buy back their own shares again. That's very positive for the financials. Most of those big banks have popped pretty good here today. That's something that the Option Professor we've been telling you about for 6 months, that these financials that are way, way down, they've already put a lot of reserves away for bad loans, et cetera. It seems like those bad loans are not materializing right now. And obviously the Fed statement is, you got extra money, go buy back your own stock. And in 2021, when the economy turns, you guys will probably make a lot of money. I think that's basically what I took away from it anyway. And so, basically that's why the financials are doing pretty good today, even though the market has been all over the place like a drunken driver. Okay, so basically that's the general idea on the commodities. And so now we're going to go over blow by blow and give you some ideas on what's happening. Okay, so there's your S&P, by the way, for those of you into the stock. You can see that the S&P is very extended basis its moving averages on a longer term basis. And that's why there's danger that after either the end of this year, beginning of next year, or who knows if it's going to happen right now, there is a significant distance between the averages and the price. And sometimes that does correct. And even some real bulls like Tom Lee at Fundstrat and other guys are looking for some kind of a corrective activity. Some of them are looking for the February to April timeframe as when that'll happen. But, you know, we're not dealing with a trained seal. And if the word gets out that there's a correction coming in 60 days, there might be some people who want to get out of Dodge before the rain starts and are not that unhappy about giving up 60 days of exposure if a 10, 15% correction is on the horizon. We'll have to see. You know, again, the seasonals right now on stocks are quite good. The money flows have been quite good. And obviously the forecast for 2021 is uniformly that we're going to be a lot higher. So again, unless something hits the ointment here, we still could get this year-end rally, and it certainly got bid up after that big sell-off. The S&P did break 3,600 momentarily, and it's come up about 100 points off the low. Again, it's not out of the woods yet. It's certainly got another hour to trade, but we'll have to see what happens. But looking at that chart right there, you can see a couple of things. We're definitely in an uptrend, and we're definitely in an extended position. Those things I don't think are very deniable. Okay, so let's keep an eye on the S&P here. And again, the further away you get from these averages, it's not less risky. In other words, the more overbought you get, the market's not getting less risky, it's getting more risky. As you can see, when it gets very extended like it did here in January, the pullback can be very dramatic if something changes. Here, again, we were up here, and then we came back down sharply. So it tends to move back towards its averages at some point. And again, the lowest one here is 3,200. Many people are saying 3,350 to 3,550 is the pullback. We almost hit 3,550 today when you think about it. We broke 3,600. So we'll have to see how they close out the year. Again, seasonals and money flows are generally very positive going into the end of the year and the beginning of the year with IRAs and everybody, you know, picking up money. The value trade continues to be a good one because, again, banks are a big part of the value trade. So you can imagine value is not getting hit nearly as much as some of the other sectors. Okay, let's get over to the commodity sector and start out with the U.S. dollar, because the U.S. dollar is really the key here as far as where we're going to go. A lot of people are negative on the U.S. dollar, and they've been right to be negative on the U.S. dollar. Again, it's been coming down for quite a while. So let's take a look and see what's going on here. U.S. dollar index. And I'll give you a little update here when they give me the graph, which they just did. And you'll get the idea. Now, this is longer term graphs going back 20 years. I'll get into shorter term graphs on each one of them as well, but you get different time frames so you get an idea of what's going on. Okay. Starting out with the longer term one, here we go. And this will also give you the RSI. All right, as you can see on a longer term graph, this thing has definitely rolled over. 105 was a high point in 2017. It was a high point here in 2020. That was after the crash. Everybody ran into the dollar. And that's pretty much looking like the Space Needle there. And now we're underneath all the averages. But we have some support down here where the 2018 lows were, which is around 88. And we are right here in the area of 90 right now, 88, 89, 90, okay? Could we have a rally here? Well, we could, but this RSI obviously does not bode well for what the dollar looks like. So again, that's very positive for commodities, okay? Some of the currencies that we thought have been very good. We've been telling people about the euro here, and I'll tell you exactly why. Euro currency right there. Here's the way we've been calling it in our weekly update, okay? We thought there was resistance on it at 110. And you can see here, once it got above the red line, that was our first signal that it was getting positive. Then there was some resistance where the blue line was at 115. So we were very positive at 110 and 115 to be long the euro. Now, 120 was resistance, right? Because see, that's where it broke from right there. And you see, once we got above 120, 119, 120, that was the next buy signal after this consolidation. So right now, it is looking like a positive market. Look at the RSI here. It's coming in at 66. So again, could we see pullbacks? Well, you're getting a little bit away from the averages. So of course you could get pullbacks. And if you got a pullback, where would a logical place have some support? Right at the breakout point of 120. Okay, but these averages are starting to turn up, but they haven't crossed. And when you notice, the big moves happen when all three cross. When all three cross, that's where you get bigger action, right? So these things have not crossed. Right now on the euro, you're looking at 114, 113, 114. So it all comes in right around this area. We need to stay above this area, get these things to go, and then maybe you could get more of a pronounced move towards 130. 130 is a reason, again, 130 to 135 is a target price because that's where it kind of broke down from. That doesn't mean, and of course 125 right here is also resistance, but the mood is positive on the euro, and pullbacks look like they should be taken from the buy side. With regards to another one that we have liked was the Australian dollar. And that one we got positive when it broke above 70. And we'll show you why. Okay, you can see here, broke above 70. That was your entry point to get in. Again, just like the euro, they all haven't crossed. And when you get the bigger moves, they all have crossed, right? When you get the bigger moves, they've all have crossed, okay? So again, you know, when all of them haven't crossed, sometimes you get a rally, but then you get a pullback. So again, pullbacks towards the 70 and 71 area. It would be very interesting to us as far as getting back on the long side. This thing was downtrending and the RSI was under 50 the whole time, right? Now the RSI is trading above 50, currently at about 59. So again, if you had a little bit of a pullback and the RSI pulls back a little bit and holds 50, that would be a very good thing. But right now it looks like what? The upside is wanting to be where it goes. Okay, but again, big upside. You know, it can happen. Right here, you had a big upside from here to here, and they hadn't crossed, right? But then they had a big pullback, and that pullback was where you buy, okay? Because once they do cross, that's when you go from 85 to 110. When they all cross here, you go from 100 all the way down to, 65. When they cross over here again, you go all the way from here to here. So again, bullish on these currencies. But again, pullbacks are where you'd probably want to enter, or dollar cost average. What does that mean? If you want to get 5 positions going, you put one on now, and then you play the prices right with the rest. Dollar cost averaging is not a bad thing to do when prices are high, simply so you have something on the books in case it keeps going, but you're saving some powder in case you get a pullback. So those two currencies seem to be the best as far as trends are concerned. To give you an idea on the Japanese yen, that wasn't doing very well for a while. Let's see if that's turned. I think it broke above 90, 95. I think that was really the signal to get in there. Let's see what the yen looks like. Yeah, you see above 90, you know, that's where it gave you the buy signal. Where's the RSI now? Okay. Now, if we're going to get a big recovery, that probably means we're going to buy a lot of stuff. And if we're going to buy a lot of stuff, we're going to buy a lot of stuff from Japan. And so obviously, the better we do, the more robust our economy, it's probably good for them. So is that a possibility to take off further as a recovery trade? It's possible. And the RSI is in an area that's called bullish. So you got the averages all crossed. So actually, this is technically better than the other ones. And again, a little bit extended. So pullbacks here, look like they should be bought. So you got the yen, you got the Australian, and you've got the euro, and that's about it. British pound, they got their own problems there right now. Looks like they're having a mutiny on Boris Johnson's bounty. His popularity seems to be going out the window. And but again, we thought this had potential as well because, again, all these things are negative news, and they still can't break it under 130. So as long as you're above 130, the path of least resistance is to the upside on the British pound. And again, if it gets going, there's a lot of real estate above. So if they get a Brexit deal sooner rather than later, and if they figure out this virus in the short run, this is another one that could benefit as well. So there's another currency that might be worthwhile. Okay, let's turn towards the area of crude oil. And I'll tell you what we've been saying on that, because we've had that one covered since the big March blowout. Again, our feeling on this was as simple as this. It went negative $37. I mean, is that a climactic sell-off? I mean, do you have to be from Harvard to figure out that's a climactic sell-off when you go negative $30 a barrel? So obviously, and then, you know, Oxy Petroleum, OXY, they had 10-year bonds expiring 2029, non-callable, and they were trading for 35% yield. Now, again, there's a lot of fairly well-heeled investors in Oxy Petroleum, and 35% yield is a heck of a lot of yield. I mean, that means every 100 grand you put in there, you get 35 grand of income a year. That sounds like a pretty good deal. And of course it was, because that yield is now down under 5. So again, we've been on this crude oil thing ever since the low. And of course, the yields have been fantastic. We like best of breed, always have. That means your Chevrons, your ConocoPhillips, your Phillips Petroleum, and that kind of stuff. But we've also thought the crude was going to do pretty well. Now it's having a pullback, so let's go take a look and see what's going on. Hang on, let's go this way first. But again, there's obviously, we're talking about the commodities itself, but you know, you can play the commodities more than one way. You can play them through contracts on the futures, you can play them through options, and you can play them through the stocks. So again, let's put the crude up here and give you a good look at that. And I'll give you exactly what we were talking about in the updates so you get an idea of what's going on there. Okay, yeah, again, you know, this is a climactic sell-off, minus $40 a barrel, okay? I mean, you realize that everyone's driving around and they're using gasoline, right? Right. So again, when a product's being used like that and you hear the rigs are shutting down and you hear fracking's going out of business, that's supply bye-bye, supply bye-bye, and OPEC is cutting, supply bye-bye, you know from using your supply demand that you're going to probably get a rally, and we certainly did. So again, our feeling was this was a ridiculously low, and then 20 was your low, and right now 35 is your low, and right now resistance is right here. So could we work a little bit because these averages haven't crossed? No doubt about it. And could we have another rendezvous to lower prices? It's possible, because again, the news for this month, December, January, and February is going to be lousy. Okay, because obviously the virus is kicking up its heels, and those vaccines you hear about are not going to get to everybody for months and months and months. And again, travel is way down. So again, that means demand is way down, and that's why you're correcting off of this rally. But again, at some point, we are going to be bringing demand back in. And if the supply and demand dynamic improves, obviously we think it can get through the blue line, which is at 53, and maybe even get up towards this 60, 65 area under, it's all according to how we come out. If we come out as strong as people are talking about, you know, obviously 60 to 70, I think could be in the cards. We think could be in the cards. And obviously staying above 30, I think is very important. So 30 to 40 is your support zone. And then resistance right now is around 53. If you can break underneath that and get these averages to turn up by mid to late next year, you know, a number that says 60 or 70 would not surprise us at all. The RSI is still a little bit underneath that 50 number. It's right on the 50 number. So if it does turn down from here, that would be concerning, because as you can see, once it breaks, the RSI stays under 50. So being under 50 is not a good thing for the bulls. And of course, if you want to be patient, you don't have to do anything, and you wait for 50 to get taken out, or 53, and just play it for the last leg. Natural gas. Another one that we look towards a stock to play with LNG. That's Cheniere Energy. But with regards to natural gas, that's been wild. And you'll see right now what I'm talking about. Let's move it into 6 months so you get an idea in the last 6 months. Yeah, this is a wild market, because what did it do in the last 6 months? It went from 250 all the way up to 330, 335. Then it comes all the way back down to 240, and now it's back up here. Trend is clearly down on it, okay? but the red line is starting to turn. So if we, as long as we stay above 255, you know, being fairly positive on it might not be bad. LNG has a lot of resistance at 60. It's got a lot of support at 50, and it's meandering between the two numbers. Above 60, that would be very positive. And if you broke under 50, that could be stick a fork in LNG. Okay, let's look at agriculture because that's very exciting. Soybeans is something that we brought to people's attention 6 months ago, 7 months ago. Why? I'll tell you why. We'll show you right now. Okay, let's go pull back and look at the longer term. Okay, you see, we were trading here in the 8 to 9 area, and we had to make a feeling. Were we going to go down to 7 and 6 with China talking about and having to buy a lot of soybeans? And we mean a lot of soybeans. Were we really going to go to 7 or 8 or 6? Excuse me, 8 to down to 7 or 6? Or was it going to break above 9 and 10 and test this 12? Well, obviously our opinion was that it was going to break 9 and 10 and test this 12. Because of what? Because of the demand that's going to be coming in from China. And then Q3, China's demand jumped 63%. So that was your, you want to light the fuse? That's lighting the fuse. Now, we did think it might have some trouble at 12, and it did. Can you see it went up to 12 here, and then it also pulled back? But now it's gotten above 12, and so obviously the next resistance, technically, might be as high as, well, there'd be some right here because these lows come in at 1255, and we're right around there now. So this 1255 to 13 area could be some resistance. Okay, we'll have to see. But the RSI looks quite positive. Okay, and then basically if you get through that area, you know, it opens up the 15 number sometime next year. So again, this is very much extended right now. So obviously it's a very dangerous time to just start buying initially. This would be something that obviously you'd try to wait for some kind of a pullback. Is it possible to get some kind of a pullback? Let's look at it on a 6-month basis. Well, you know, where's your RSI? Yeah, your RSI was up here at 84, and now you've made a big new high here, right? And where's the RSI? It's only at 74. Sometimes when that high is up there at 84 and this high way up here is at 74, it sometimes can be an indication of a divergence, which means this could be some people getting squeezed out, some shorts and stuff like that. So, you know, you might want to look at it on a shorter term basis here at a 1 month if you're trading. And you might say to yourself, if in fact we break under the red line, that would be, you know, maybe some, or the green line, 1220 or 1230, that might be a signal that it could be rolling over a bit. And again, your RSI is not making big new highs with this rally. So that's concerning technically in our opinion. But you know, obviously the time to get in was back when we were talking about it 6 months ago in the 8-9 area. And now you should just be reaping your reward of getting in at the right time. Wheat is something that is supposed to have enough supply for whatever reason. So let's take a look at wheat. There could be maybe a selling opportunity in wheat. Let's take a look at that. Okay, wheat certainly has not had the move that the others had, and it does look technically pretty good here, okay? So obviously, if it can get above 650 with these averages turned up, you know, it does have a technical good look to it. The moving averages come in here at 553, 523, and 516. They're all inverted to the upside. That's not a negative. And the RSI is at around 60, which is not overbought. So again, it could be just be a short-term thing that the wheat may drop. But on a longer term basis, if all commodities are going to get going and they can change the supply dynamic here, there could be quite a bit of potential because it's certainly not extended tremendously off of its moving averages. Let's take a look on why people might think it could roll over from up here. And this is a 1 month situation. Yeah, you see, they were thinking this was a good place to sell because it was so overbought, and it was. But now it's starting to work its way higher. And so obviously, you know, until we break under 605 or 595, this thing still looks like it's very constructive. And on the RSI, you're back above 50. So if you were short-term trading and thinking wheat might drop, it obviously might be a much better sell underneath 605 and 595 than it is here. Okay, let's turn towards the corn, and that'll give you the last of the. So looking at it, obviously the most aggressive one right now is certainly the soybeans. But you can see on a longer term graph, the wheat could go on the bicycle and get moving. So again, they do. That's what they're saying. Secular bull market. You see these charts; they're all kind of pointing to the upside. This is going to be a long-term graph for you to look at on the corn, and give you more of a perspective on what's been going on. This stuff generally in the threes is the best time to be buying, right? 350. You know, say to yourself, it's not going to go down to 250, and ergo, once it gets above 350, there's your buy signal. So you should be long as soon as it breaks above the 350, and you should be enjoying yourself now. There's resistance right up here at the 465 area. So we'll have to see if it can take it out on the first run. But on pullbacks, as long as we can stay above 370, 360, well, call it 350 to 375, that would be the buy zone. That would be the support zone. And on the RSI, yeah, you're above 50. So again, the grains look good, but could pullbacks occur? Yes. And when you're at a high point, you know, again, one of the concepts is to use dollar cost averaging. You put something on the books, so you have something on the books, and then basically you add to it on any pullbacks, playing it with, you know, with your get out point, say here at 350. And some of these people have contracts that are only 1,000 bushels, so you know you can cut down your leverage, which obviously is something to worry about. Okay, let's see what else we've got here. All right. I'm going to save the last for the metals because I know most of you guys like to talk about the metals. So I'm going over the other stuff first. Let's talk about the softs, which is sugar. Sugar. Again, sugar, again, we were positive on at 1230. You'll see when it got above 12, that was the time to take a look at that. So let's take a look at this now. I have to go back to my other graph and put in the symbol. Yeah, again, the gold, silver, and copper and Bitcoin I'm going to go into right after we finish this stuff here. And I'll give you some different tactical information as well. Okay. So on sugar here, let's go back to the long-term stuff so you can see what's going on. Okay, you can see it's turned up, but you can see 16 is a tough racket, right? 16 is the top here, 16 is the top there. The averages are all trying to cross. They're at 1289, 1269, 1252. Remember we told you once it broke above 12 and 1230, that was the time to be long. Right now you could be holding, but you would add if it goes above 16, looking for a much bigger breakout. The sugar right now has an RSI of 58. So again, I don't like a high surrounded by lower highs, right? That's an indication of exhaustion. So right now you've got a high surrounded by lower highs, which is not so great. With regards to the pullback, again, this area that we talked about originally, 1250 to 1275, that's the buy zone or the support zone. And again, this number here, this low here would be another one, which is at 1173. So anywhere between 1173 and 1250, you definitely don't want it underneath there. And again, you get above 16, it could be like silver getting above, which I'll get to later, when it got above 20, which we were monitoring. Once it got above 20, you got the buy signal, and it was at 30 before you could spell silver. So if this thing can take out the 16, just like when the soybeans took out 12, you could get a nice little bang to the upside. Right now, you've got a high surrounded by lower highs, and technically that's not the greatest sign in the world. Okay, but again, the averages are underneath the market. Next one up is going to be coffee. And we'll tell you what we see on coffee. Underneath 100 earlier in the year, we brought to people's attention that it was a bargain. It was a steal underneath 100. You can see that. Once you got above 100, you see the red line. Once you got above 100, you got a pop to 140. That was late last year. Then you got back underneath 100, and you got back above it here. And again, 137, another big move there. And then basically it came back down and held 100, which we thought was support. And then it held 110, which is support. So our feeling is that 100 and 110 are the support zones, and that it looks like this market, if the commodities are in a bull secular thing, could have a lot of upside next year. Okay, so take a look at that, and there could be some big potential. You get underneath 110, that's your warning flag, and you get underneath 100, that is no good. And if you get underneath 100 and they get this RSI, which is currently right now at 54, and you start getting it under 50, that's not good, because you can see when it's under 50, that's when you get the big drops. That's when you get the big drops. So under 50, we do not want the RSI. And underneath 100, we do not want this market. Other than that, we're going to remain constructive. And if, again, the secular bull market is in force, this thing could obviously get some pretty good legs. So that gives you a couple of soft commodities, coffee and sugar. Let's just look at one other one, cotton, because that is sometimes a pretty big mover, but sometimes not. Let's find out. These are soft commodities. Okay, and let's take a look. Yeah, it looks like it's on the defensive here, although it is trying to turn. But again, you see, when it's going to have a big move, these averages tend to have crossed and are going in the same direction. That's why some of these charts are still kind of sloppy, in that they haven't crossed over and they haven't gotten the long-term average to point up. Now, of course, once they get that, starts pointing up here, you still got some good action before it goes, okay? But again, you know, you'd like to see these red and green shorter-term averages cross over to long-term. You'd like to see them pointing up. And then, of course, you'd like to see resistance getting taken out. But I'd keep an eye on this. What's the RSI looking like? Is it above 50? Let's find out. Yeah, so it's above 50, and that's a good thing. Again, it's suggesting that the drop is over. This red line is suggesting the drop is over, and the price is making new highs here, so it's suggesting that as well. But it's also suggesting that it's a little bit early in the trend because these averages have not crossed over and turned up. So again, keep an eye on it and consider the dollar cost averaging concept so that you have something on the books, but then you also have what? Powder dry in case a better opportunity comes along. Okay, so let me see here. Let's take a look at some of these metals now. Well, I'm going to go over Bitcoin real quick. We look at GBTC as a proxy for getting involved with Bitcoin. Why? Because it trades on the exchange. Why? Because there's a lot of volume. And why? Because it's a lot easier to punch in GBTC and get involved and get a wallet and figure out where to get these Bitcoins and all the rest of them, right? So BS right or BS wrong, this is the way we've looked at it. And ever since it's been, well, I'll show you like in the last year now, ever since it got above 10, it's pretty much been make it 10 to 12, you know, it's been in the buy cycle, right? And it's never broken the long-term average. So the long-term average is way down here. And so the market is about 50% above its long-term average. This is a tough time to start initiating a new position, right? So again, if you did want to go with the dollar cost averaging, this would be a place to put something on the books maybe, and then keep a lot of powder dry and see if these gaps are going to get filled here and get maybe down to the support of 24. And if that were to happen, it would be much more interesting. And then you've got your net, which is the long-term average. And the net comes in right now at about what? 20, a little bit under 21. So you got 21 there, okay? And then obviously this thing gave you the buy signal way down here. So that's what Bitcoin looks like. And obviously, is it a great thing? Sure, if you own it. Is it a great time to buy? Well, maybe it's going to 40 right away without stopping. So that's why you might put something on the books just in case that happens. But be aware that you might have to take some pain if there's a correction to come down towards 24 and fill these gaps, or to come down and test the long-term average like it did here and like it did here. And you have to be prepared to accept that volatility when you start buying things that are at this kind of an extended price. But obviously, what's the story on Bitcoin? There's a scarcity element, much more scarce than gold, much more scarce than fiat currency, which they can print and print and print and print. And again, the millennials, which is really the next generation that you should be worried about their buying habits and their habits of general, are clearly digital people. And a digital currency is not going to be a weird thing to them because everything is on the phone, everything is online, everything is delivered to them. And so, I don't think there's a particular reverence to George Washington and Andrew Jackson and the other people that appear on the currency. And they can see how much currency is being printed during this crisis. And obviously they would not be a hard generation to convince, let's go with a Bitcoin and let's forget this paper currency. I think that's the way the world is going. Plus, these guys are getting very legitimate players coming into their area. You've got Square and you've got PayPal. Mass Mutual is doing something with it. Fidelity has some activity with it with cash loans. And others have talked rather respectfully of this. So the bottom line is I don't think this is going away. But like any market, especially an early market like this, some people like Tudor Jones call it like buying into a tech stock early phase. So you're going to get a lot of volatility and a lot of, crazy moves when you get into a tech stock early investor. And again, when you get this kind of a run up, it is hard to start putting an initial position on when you know where you are. But what you'd think about is, can you take the volatility of going from 32 down to 24? Can you take the volatility of going from 32 down to 21? And can you have some of your money in there and then obviously add to it if you get a better price? Or just do a dollar cost averaging over periods of time. Every month, put a little bit in. Every quarter, put a little bit in. And then basically try to accumulate this thing over time. Because if people who did that between 2020, well, let's look at 5 years. Let's see how long this thing's been going on. Yeah. So if you've been accumulating it since 2016, you got that big run up, right? Okay. But, again, you're obviously only going to be doing so much buying up here because if you do dollar cost averaging, you're going to have a lot of buying in here. So then you get whacked, but you're continuing to accumulate and accumulate. So you get more and more Bitcoin, more and more rallies up. So you're buying less here than over here. And then again, it comes down. So you're dollar cost averaging again. And again, dollar cost averaging has been pretty much the way to go here. So again, that's our opinion. That's our viewpoint. But that's been a viewpoint that seems like over time has panned out pretty well. Because putting it all in up here, obviously you would have lost all this money and probably abandoned it, right? If you put all your money up here and it goes back down to these numbers down here, 14 or something like that, you're going to probably abandon it. So that's why the dollar cost averaging can smooth out the bumps and keep your head straight when things get volatile. Okay, so that's basically what the story is as far as we see on Bitcoin. Obviously, very big future to it, I think. And we think, and basically, again, this vehicle here, go look at the volume. There's a tremendous amount of volume. So getting in and out of it has been not a big deal. Okay. Let's turn now towards copper. We're going to hit those metals right now. Okay, on the copper. This thing got positive at 250, and we talked about that 6-8 months ago. I'll show you why. Okay, can you see here? We break above 250, then you get above what? The red line, you get above the green line. So that was our indicator, and the RSI broke above 50. That's called get involved if you want to get involved. And now you've been riding it up the whole time. Is it extended here? Absolutely. Is this like everything else? Again, it's very tough racket to get in after things have already run up. But that doesn't mean they can't keep going. So one of the ways you try to work with something like this is the dollar cost averaging concept, where you get something on the books and then you accumulate over time because you think this blue line, which is the longer term average, will continue to rise over time. RSI here, I mean, you know, RSI here was at 70 and the RSI here right now is at 75. Look how much higher you are, and the RSI is not that much higher. So again, this area right here could be a situation where it's having a hard time. That area right now is around 365. Let's pull it back to the 20-year graph and see if that helps you. Yeah. So this thing has been at 460. People are thinking it's trying to make a run at 4, which I think is $10,000 for a ton of it. Basically right now, again, it's very, very extended. Okay. That doesn't mean it can't keep going, but it means that if you're going to try to get involved here, the dollar cost averaging makes a lot of sense. And the RSI right now is probably getting up there too. There you go. RSI is at 70. Again, infrastructure, be very good for this. Housing, very good for this. But again, this is all known with the housing. Again, so that's why it's extended. And, you know, there's only so many people who need so many houses. It's not unlimited buying of houses, unlimited amount of new construction needed. So, you know how contractors are. You know, when things get going good, they build an awful lot, right? And things slow down. I mean, I live in an area where they got nailed in 2000, they got nailed in 2008, and they got nailed, at other times as well, because they build 90,000 communities and they think everyone's going to keep coming. They do come, but then at some point they don't come, and then you have a supply problem. I'm not saying we're there yet, but that's the next stage. And when you're investing, you have to worry about where the puck is going, not where the puck is. And so again, this stuff here is very positive, and I'll show you a couple of markets that we have been focused on and have been very good to us. One is Freeport-McMoRan, which anything above 10 was a bargain, as you can see. So there's your buy signal at 10. You should be in there then. Definitely add some more when it broke above 15, and you should be sitting there enjoying the ride, right? But is it possible it's going to have a pullback? Of course it's possible. This low here came in at 26 and change. This high here is coming in at 25.43. So you got these lows here could be resistance, and you're coming into that area now, and your RSI is pretty extended. So again, you know, this is doing very good today. But again, this is another dollar cost averaging concept. You pick a little bit up there and you try to dollar cost average. Hopefully you get some pullbacks. If you don't, you have something on the books at least. But again, there's a lot of potential to this stuff, because look where it used to trade. You know, and these guys have got, I think quite a bit of activity as reserves are concerned. But this thing used to be as high as 61 here, and used to be as high as 63. And even in 2015, it was at 40. So there still could be quite a bit of real estate here, but I doubt it's going to go in a straight line, but it could. Clearly right now, it looks like it's extended a bit, so you got to be careful. Where we were talking about it in our weekly updates is down here. In fact, even lower. All right, because again, the idea here when it hit 5, when you get anything like this down at 5 or underneath, you're buying an option. What does that mean? You're paying like you would for a call, right? And the call never expires unless the market goes out of, unless the stock goes out of business. So, you know, you can buy things that are under 10 and you can hold them forever. And, you know, Freeport-McMoRan is into copper and gold and silver. You know, they're not going out of business as far as being a demand for that. And obviously at some point prices switch on those things. And when they switch, that's when you get paid. So again, when you get stuff like this, that's, underneath 10 and you load up on it, you just hold it and wait for the prices to turn. And ultimately, generally speaking, quite often they do. Next one here is one that was paying a good dividend. I know a lot of you guys, are doing the futures, but again, you can play this thing a couple of different ways. That's all I'm talking about. Okay, so here you go on Southern Copper. Again, we were talking about this when it broke above 35, right? And what did the RSI do when it broke above 35? It started getting above 50. right? So you get the RSI telling you it's a go. This is telling you it's a go, and the copper prices are telling you it's a go. So that's why you got to go. And the dividend on this thing, I think, was 2 or 3% or even more. And so obviously, it's giving you good cash flow, and it's giving you good upside appreciation. And again, it's making new all-time highs. So what does that mean? That means it's a little bit on the overdone side here, and it could come back down. So this is a tough time to initiate positions on many things, right? But it's giving you an idea that a secular bull could be happening, and that means you could accumulate in some of these things if the secular bull is going to be happening, and it could be a good asset to have on the books. All right, let's turn to the big kahunas here. We'll start out with gold. And the gold market, again, will tell you exactly what we thought on gold. On gold, we thought it was a breakout once it got above 1,400. So we were very positive on gold once it broke above 1,400. Now, when it got to 2,100 and everybody was drunk out of their minds with $2,500 gold and the world's coming to an end and paper currency will be used for nothing, and if you don't own gold, you're going to die. Okay, well, that obviously is called excessive optimism. And when it gets excessive optimism like that, then obviously we got to be thinking a little bit more rationally. So obviously, once it hit this number up here, first of all, it made a new high above 1,900, right? So obviously that blew out everybody who was ever negative on it, and that got people to buy in. Okay, now when you're at 2,100 and your long-term average is at 1,400, that's not good. It's extended and you're going to pull back. That's, again, the theses I'm talking about with many of the markets I showed you. I don't know if they're going to pull back. You don't know, but we're talking about odds. We're talking about probabilities, and we're talking about logical thinking. Sometimes logical thinking is terrible. But right here, you're talking about at 2,100 that it's going to, our position was it's going to pull back and consolidate these gains. And the logical place would be between about 1,800, where the moving average was 1,775, and 2,100. And so for the last few months, what's it been doing? Back and forth and back and forth. Now, last month, we went down here to 1,775, which is exactly where the average was. And it's exactly where we said, if you want to take a bite, this is where you take a bite. But where you should have taken a bite is down here, and you should just be enjoying the ride. And when it comes down and tests these lines, that's where you add. So again, when it's up here, you're not adding. Down here, you might take another bite. So we've established a couple of things with this chart. One is that the trends are up. Two is that the averages on the longer term come in much lower at 1,590, let's call it 1,600 bucks, and down here at just under 1,500. Okay, those are the longer term graphs. Now again, if we're in a roaring bull market, the likelihood of coming all the way down to the blue line is probably not that high. Coming back towards the green is not off the table. But right now, you can say that the 1,775 area is the low of the move, and you got a double low there. Currently, we're at 1,881. But you know, today, it went as high as 1,900 and change. And then basically it's given up about 25, 30 bucks. So ballpark here is we think it looks like it's going pretty good. Now, I'm going to talk about some hypothetical strategies right now. Based on the idea that 1,775 is the low of the pullback and it won't get taken out, and basis the idea you think there's going to be a rally in the next 90 days. So what are the theoretical givens in this hypothesis? That A, you are looking at a gold pullback of 1,775 as being the low of the pullback, and B, that in the next 93 days before these options expire, you are going to get a rally up towards 1975 or higher. Okay, so here you go. These are, again, our ballpark figures on the options. So I'm going to show you basically the put side at 1750 for April. April expires 93 days from now. Okay. Again, this is not a recommendation. This is showing you how something works. It's hypothetical. But again, the ballpark numbers I'm using are where we're at. Now, you're looking at 1750 on the put. We know the low is 1775, so the 1750 put is underneath the lows by about 25 bucks. In that position, you're going to sell the put. Now, when you sell a put, you're agreeing to buy the market at 1750. And if you're doing 100 ounces, that's 100 times 1750, or it's $175,000 worth of gold. So you got to understand the leverage you're using, right? Now, that's going for about 25 bucks. If you want to do a credit spread, you would sell the 1750 put and buy the 1700 put. That's going for about 13. If you sell a 1750 put and buy the 1700 put, you're going to get a credit of 12 bucks. Again, this doesn't count commissions or spreads or anything else. This is a ballpark figure. So now you get, in this example, you're getting a $12 credit. Okay. Now there's two things, well, many things, but there's two things I'm going to cover right now. One is, let's say you did the 1750 and you did it without a hedge on, which means it's a naked or uncovered option, which means you have unlimited risk under 1750. You take the $25 you receive on the 1750, and there's a couple of things that I'm going to show you. One is you could buy an outright call for April at 2050 and pay 25 bucks. That's called a sell the call, buy the put. It's kind of a reverse collar. So basically, what are you doing? You're going to be agreeing to buy gold at 1750, and you have the right but not the obligation to buy gold at 2050. You're getting 25 bucks on the put credit in this example, and you're paying 25 bucks for the call at 2050. That means anytime between now and 93 days from now, if the market were to drop, you are liable to be buying at 1750, which on 100 ounces is $175,000 worth of product. Now, you have the right to buy at 2050. So if the market stays between 2050 and 1750, both of these options, if they stay in there all the way till expiration, 93 days away, both of these options will expire at worthless. So it's one credit and one debit, and they offset. Now, if the market were to jump up to 2100 and you have the right to buy at 2050, you'd have a $50 credit or $5,000 credit because you had the right to buy at 2050 and you paid for that option by selling the put. So if it were to take off, you would be in a good situation from the standpoint of you'd own that call. Now, again, the big risk is obviously if it tanks. And again, one thing that you could do is you could close out both positions. Obviously, during fast markets and unprecedented markets, that could be difficult or impossible to do. But the bottom line is the exit strategy would be to either close out the positions or to take delivery at 1750 or take a position on at 1750 and be liable for $175,000 worth of gold at 1750. But again, this is a way to try to take premium in and use it for a position. Now, the other thing you can do is if you take in the premium of 1750 at $25, you could also buy a call spread. And that's where you buy a 1900 call and sell a 1975 call. Same for April. And the differential there is about 25 bucks, which is what you received on the 1750 put. What does that do? That very simply gets you an ability to make the difference between 1900 and 1975 or $7,500. And again, you are taking the premium out of that put to pay for it. Now, when you do call spreads or any spreads, you only get the full amount of the spread when you have no premium in both options and the market is above the top strike price. because you have to get all the time or the premium value out of it, and they both have to sell and be going for intrinsic value to get the 7,500. Again, another way to go is that spread where you get the $12. And where do you get that from? 1750 and 1700. That's a credit debit spread. And you take the $12 and either keep it as long as it's above 1750. And the risk is $50, the difference between the two strikes, minus your $12 or $38 of risk maximum. But you can also buy a call spread of 1950 and 2000 for 12 and try to make $5,000 if it gets above 2000, risking the $12 to do it. But again, the $12 was paid for by the credit spread. So again, there's a lot of different ways to play it from the option side to give you some idea of what we look at on the stock side. GDX has been our buddy ever since it broke above about 30. And we'll show you that right now. 25, we got the signal on that, around 25. Obviously riding high, still having trouble getting back up here though. And that's why gold is not out of the woods on the upside either. But again, the trends look like they're up. The pullback has occurred. So this is an area just like gold where someone might take a bite on it. And of course, 30 would be the big number because that's where these highs are. Okay, I got a minute or two. I'm going to jump into the silver. It is hard to cover everything that we cover on a weekly basis with our opinions and our observations, but I'll give you a quick one on silver and give you a little idea on how we thought on silver. We think we have some information that adds value to your situation, so that's why we encourage you to get the weekly update. Okay, so again, what was our feeling on silver? Our feeling on silver was we got the buy signal as soon as it broke above 15. And can you see 20 was a key area? Once we got above 20, look how quick it went to 30. But when it was at 30, we warned people that it's way overbought. It's into resistance right there. And you've got to be careful that it's going to have a pullback, which it did. But we thought it would come back towards this 22 number, which is exactly what it did. Now, again, there are ways of working with this thing as well, because the next time it goes, if it takes out 30, there's a lot of real estate up here. So silver does have a lot of potential, and the RSI right now is definitely looking pretty good. Actually, our opinion is silver on a percentage basis will outperform the gold. And so there's, again, many different ways of playing it. The silver options, the silver contracts, and then, of course, you've got things like SILJ. And I'll give you two other quick ones here before we have to sign out. This thing here looks good to me because we got involved with this stuff and we liked it above 10 and then basically above 13. You can see 13 is a big support area and it does look like there could be potential here as well. Another stock that people like to look at in the silver is PAAS. There's so many of these mining shares, but I'm going to mention a couple of them that, in our opinion, our observation has been a pretty good place to be. This thing had a big run, and then it's had a pullback. Anything above 20, 16, yeah, there you go. You get above 16 here, that's the time that it looks good. And again, sometimes when the market tanks and the moving averages are still rising, this is very temporary. That's what happened to the S&P. It broke under 2,800 temporarily. Once it got above a 2,800, that's where the long-term averages was, and you can see it's still looking good. Right here, again, 28 area where the moving average is, good place to take a bite. And the last one is Newman Mining. Pretty much the Cadillac of the gold. I think they have 6 million ounces a year that they're going to be producing. That sounds like a lot of gold. So again, this stuff has been a great deal. Again, once you got above 35, that was your signal. Obviously way overbought. That's why dollar cost averaging we talked about, right? And then down here, the RSI is looking pretty good, but this is where you were supposed to maybe take a bite. Again, they're all not out of the woods yet. They are looking like their corrections are at least getting a little bit mature. Okay, every week, again, we have a market update that we give you all this information absolutely free. You simply go to Option Professor, OPTION, professor.com put your email in, and then you're in the queue. Again, we're very knowledgeable in our opinion on all these things. I think you get valuable information from a source that has a lot of experience in this area. And so you're getting an opinion and an observation that is well researched. The other thing is, if you have questions, we went over a ton of information here. There's a ton more to go over. If you have a question, shoot us an email, optionprofessor@gmail.com. And we'd be more than happy to share our opinion and our view on what your question has to do with.